This video is going to help you find the break-even point and time period so that you know if it's at 6 months, if it's year 2, year 3, and you'll have a better idea of that. So what we're going to do is take this break-even example that finds break-even in units and use this information to fill in the financial projection tool, which I have open here. That's an Excel file, and find the break-even point as far as time periods. So for this break-even example, we have a business that is selling personalized t-shirts for $10 each. All right, so we're going to go ahead and start filling in the financial projection tool with that information. This tool is set up so that you can put in 6 different product or service categories. So since this is our first one, I'm going to change it to say t-shirts. You can do that if you want, you don't have to, and put average price per unit, which is the $10 from that example that we just looked at. Now you notice here we need to put in average material cost per unit and average labor cost per unit. So I'm going to open back up this break-even example and find that information. So we have these variable costs here. The raw material for the t-shirt is $3 and the shipping charge is 50 cents. So I'm going to add those together and put that $3.50 in the material costs for this t-shirt product, and then I'm going to add up the hourly labor to personalize, which is $1, and the sales commission of 10% of $10, which is $1 as well, to get $2, to put that in the average labor cost per unit. So my material costs were the $3.50, my average labor costs were the $2. All right, so you can see here this automatically calculates what we found with this break-even example. Adding up these variable costs, getting to $5.50, and price minus the variable cost is $4.50, which is your contribution margin or gross profit margin. So if we go over here to this Excel sheet, you notice when I put that information in, it totaled the variable costs, this product costs for the t-shirt, which is $5.50, and got the same result, that $4.50 gross profit. It also finds it as a percentage. So this 45% is the $4.50 divided by this $10 to get 45% as your contribution margin as a percentage. Now that becomes important when we're looking at the break even, the way we're going to do it using sales and time periods. All right, so let's move to this portion of the financial projection tool, which is key. If you want to know the time period when you're planning to break even, you have to plan out your monthly sales for years 1, 2, and 3. All right, so let's say that we have, you can perform market research and we have a good understanding of our target market and also how much is reasonable to sell given the number of employees that we have with our business. In that first month of operation, we're planning to sell 100 t-shirts, and then it's going to increase a little bit from there, and maybe the rest of the first year we're planning on averaging about 200 t-shirts a month. Now if you have a seasonal business, you'd have to consider those types of things in adjusting your monthly sales projections. Now years 2 and 3, maybe we're planning some expansion, more marketing efforts. We're going to make more investments, hire more people, sales people. So we're anticipating pretty significant sales growth in years 2 and 3. So let's just put, if you put percentage here, 20% for example, it will automatically increase our sales numbers here by 20%. So if you're like, oh, I'm looking at those from 200 to 240, is actually thinking of a higher percentage, just change that percentage up and you could see it can increase from there. All right, so let's say we're going to be really aggressive in year 2. We're going to see significant growth in our sales because we're hiring more salespeople, we're expanding into the market, whatever makes sense for your business. And then maybe you would do the same in year 3, okay? So these are not standard percentages. You'd want to make sure it makes sense given the numbers that you're selling and what those increases actually look like from year to year. All right, so you notice it just did a standard increase from year 1 to year 2 and then year 2 to year 3. Okay, so as you know, to find break even, you also have to consider fixed cost. So that's part of the break-even formula, and we have these fixed costs that are given to us in this example. So fixed costs of rent of $800, telephone $100, insurance $50, bookkeeping $100, and loan payments of $300 per month. All right, so let's assume that those costs, which total to the $1,350, remain consistent just for the sake of this example. So we're going to go back to our financial projection tool and click on the expenses tab. Now, if you use this financial projection tool, how it's set up to be used, then you would input startup costs, you would input salaries and wages that would then calculate to annual. And then it has a space for other business expenses. Since we're really just using this tool right now to find the break-even in time period instead of units, we are just going to use the tool so that it doesn't necessarily generate all the income statement, balance sheet, and ratios that we can use, but just to focus on the break-even. And if you're doing that, then it is fine to simply put all of those costs in these business expenses. So right now, I'm basically just changing these titles so it's easier to keep straight to what is on that example. The rent, the telephone costs, the insurance, the bookkeeping, and loan payments. Again, if you use this tool how it's intended to be used, you'd have some fixed assets that you'd invest in, and then it would calculate loan payments down here. But we're really just using this tool to find the break even. So I'm going to go ahead and put all those expenses right here and put the monthly amounts because that's what we know, and it will automatically calculate annual for me from there. So you can see I have these costs that I'm just transferring, this 800, 100, 50, 100, and 300 for all of these costs from this break-even example where I got all of those costs that you can see right here. All right, so if you continue with this example, you can see that we take the total monthly fixed cost divided by the gross profit margin. To get that, you need to sell 300 t-shirts per month to break even with this business. But what we're wanting to know is what month or what year are we going to break even. So with the information that I've inputted so far, notice that $1,350 is the same total that we got for the monthly expenses with the example here, that $1,350, but the spreadsheet automatically totaled it for us. I'm going to go ahead and click now on the break even tab. All right, so the break even tab totaled our annual fixed costs. It also totaled costs of sales as a percent of sales and this contribution margin, this 45%. Notice that that is pulling from this 45% right here. All right, and the total annual fixed cost, the $16,200, is pulling from there. You can see if we were to divide that by 12, we get the $1,350 monthly cost that we have in that example that we're using. All right, so what you have here now is break-even sales in dollars. So you need to sell $36,000 worth of t-shirts to break even. Okay, so how this number was calculated, it took the $16,200 divided by 45% to get the $36,000. All right, that's where that number comes from. Now we're going to go over to our cash flow statement. And looking at that cash flow statement, you will notice that you have a product t-shirts, which is pulling from that revenues tab. And you can see that for the first year, it has your sales based on the numbers that we put in on the revenue tab for how many t-shirts we're going to sell that year. So you can clearly see from this, it also has the year one totals here. I'll make that a little bit bigger. That in year one, we're going to have $22,500 in sales. Now look back here at this break even tab, you need $36,000 to break even. So you know from looking at this cash flow inflows, you are not going to break even in year one. All right, so it also has year two totals, $33,750. So you can see looking at year two, you're not going to break even in year two either. Now jump on over to year three. That's where you can expect to actually start breaking even for the business. You can see it's $50,625 in sales, which exceeds the break-even requirement of $36,000 to break even. Okay, so this is going to help you determine break even. You know from this information that you're not going to break even until year 3 with those projected sales. Now, if we go back and change year 1, 2, and 3, so let's say in year 1 that we're going to, well, let's just do 250. We're going to sell 250 sweatshirts maybe in the first few months, and then we're really going to pick it up after that and sell more, and then we'll keep our increases the same just for the sake of an example. So once you change these unit projected sales, how much you're going to be selling, notice the break even hasn't changed. $36,000, that's what you need to break even. And what has changed then are these numbers, all right, which it looks like, and pull from 250. Okay, just checking those. You can see then in year 1 totals you have $35,000, which is close to your break even. Year 2 you have $52,500. In year 3 you have $78,750. So you can pretty confidently say that in the beginning of year 2, or month, 13 of your business, based on your monthly projections, you're going to have that much sale to get you over to the 36,000 is when you're going to break even for your business. All right, I hope this helps you with finding the break-even time period for your business.